When Silicon Valley Bank collapsed last week, it set off a domino effect across the banking industry. Signature Bank failed too. First Republic had to be bailed out by other banks. Overseas, Credit Suisse needed a big loan from the Swiss version of the Fed to stay afloat. And all that drama led a lot of us to wonder, how safe is the money I have socked away? And how did this all happen in the first place? NBC's business and data reporter Brian Chung explains in our Sunday Focus.
The stunning collapse of Silicon Valley Bank last week sent shockwaves through the banking sector.
Silicon Valley Bank becoming the second largest bank failure in U.S. history.
Rattling customers.
They just came out and told us that the bank is shut down.
And stoking fears of another financial crisis.
Americans can rest assured that our banking system is safe.
SVB, true to its name, grew as fast as the tech industry did. The bank of choice for startups and venture capital funds, the bank expanded at a breakneck pace, all the while putting much of its capital into safe, long-term investments like U.S. government bonds. But as inflation hit and interest rates rose, those investments became far less valuable.
The market did not respond like they thought, and the ramifications were that they were running out of money.
Word soon spread in the tight-knit tech community that SVB was selling investments at a loss to shore up its balance sheet. Panic crept in, and customers suddenly wanted their cash back fast. On March 9, SVB customers withdrew $42 billion in just 10 hours. A day later, SVB collapsed, followed shortly by Signature Bank. U.S. bank regulators quickly moved to stabilize the markets this week, announcing they would fully insure all deposits at the two failed banks, meaning people would get their money back beyond the $250,000 FDIC limit, as the Fed offered a new way for banks to get cash quick if they needed it.
This week's actions demonstrate our resolute commitment to ensure that our financial system remains strong and that depositors' savings remain safe.
On Thursday, a group of 11 major banks also pledged $30 billion to help prop up First Republic, another troubled bank that saw customers start to pull their money, sparking fears it could be the next to go.
Are you worried about this same issue playing out at other banks as well?
I think the vast majority of the banks, including the regional banks, are quite healthy, quite sound, but fear is a real problem.
Former FDIC Chair Sheila Bair says the root cause of these closures is as old as banking itself.
It's classic Jimmy Stewart problem.
Bair, of course, referring to that holiday classic, It's a Wonderful Life.
Don't look now, but there's something funny going on over there at the bank, George.
George Bailey, played by Jane Stewart, begs his customers not to withdraw their money in a panic all at once.
You're thinking of this place all wrong, as if I had the money back in a safe. The money's not here.
If depositors rush into a bank and want all their money out at once, they will force an otherwise healthy bank to close.
The Jimmy Stewart era of showing up at your bank branch is over. Bank runs nowadays are an all-out sprint. Supercharged by smartphones and social media, people can shift money and sow panic faster than ever. It's a not-so-wonderful sign that modern banking, for all its advances, is still at the mercy of our most primal nature.
We can get through this thing all right. We've got to stick together, though. We've got to have faith in each other.
And Brian is joining us now. Hey, Brian, good morning. So listen, as you have laid out there this week, the markets felt a little nervous. I think people felt a little nervous. And now everybody's looking ahead to a key meeting from the Federal Reserve coming up in just a few days. Bottom line, what are they going to do? Raise rates again? Are they not? Where do we think they're going to land?
Yeah, Hallie, well, prior to all the banking issues, the mission was clear, right? Lower inflation, make borrowing costs higher to take steam out of this economy, and slow inflation from the 6% yearly rate it's at now to hopefully somewhere closer to 2%. But the bank blowups complicate that, because one of the dominoes to fall that led to SVB's collapse was the Fed raising rates at the fastest pace since the 80s, with 6 hikes of at least half a point in just the last year. So even though the expectation was for additional rate hikes to continue slowing inflation, now there's this concern that it could break more banks if they hit it too hard. So how are they going to thread the needle? Well, it's likely the Fed will raise rates by as small a move it can do, which is 1/4 percentage point, if they choose to raise rates at all, stopping the upward trajectory. We'll have to find out on Wednesday, Hallie.
Yeah, a lot of people looking toward that. Brian, thank you very much. Appreciate it.
Hey, thanks for watching. Don't miss the Today Show every weekday at 11 a.m. Eastern, 8 Pacific on our streaming channel, Today All Day. To watch, head to today.com/.
Hi, good evening everyone. This is Hilary here from VIA and welcome to another session of Deep Dive series. So today, as Kaden is feeling a bit unwell, so I'll be taking over for the whole session for tonight, and I hope that you will enjoy our session about deep diving into the banking crisis. So just now, earlier on, when you have watched the video by Today, which was nicely done by Today, and I hope that you have learned more in depth about what happened in the banking industry for the past few weeks, where we saw one bank after another bank as if they are collapsing like a domino. So for tonight, we will find out more on this banking crisis. So right now, some of you, I saw that there are about 30 plus you are watching this video, so you must be curious about, is there any opportunity for the bank stock since the share price are dropping? Is it now the good time to go in and buy certain banks? So maybe we'll find out more about tonight. So earlier on, they mentioned about SVB, which is the largest bank failure since 2008, because SVB is the 16th largest bank in US before it collapsed. Then followed by Credit Suisse, which is a much more bigger deal because it's one of the well-known banks in Switzerland, and it is also a famous bank for its secrecy. That means people who don't want to have their information known by the authorities, they will save their money into this bank and such. As since this already collapsed, it would definitely cause a really big tremor around the banking industry. So with the collapse of the Credit Suisse and SVB, some people might be thinking, is this the start of a global banking, or is it something similar to 2007 and 2008 bank failures, which some of us might be vividly remembered how it actually affected the whole financial industry. So for that, we will deep dive into this banking crisis and also one of the bank, which is Bank of America. And before we start, I will have to put up a disclaimer to make sure that to let people who are watching this that we are actually not promoting to buy Bank of America or say that this is a good stock to buy, but we are solely to illustrate the application of value investing methodologies and various valuation methods in the context of real-life companies, which for this case, we will look into Bank of America. So under no circumstances does any information provided in the case studies represent a recommendation to buy, sell, or hold any stocks, as we do not take into account of the individual characteristics, profile, and or risk appetite of a given investor. And in no event shall VIA or any author for tonight, which is me, be liable to any viewers, guests, or third party for any damages of any kind arising out of the use for any of the content shared here. Neither Mind Kinesis Investment Private Limited, Value Investing Academy, VIA, nor the authors of the case study are operated or by affiliated with any broker, dealer, or licensed financial advisor, as neither VIA nor the authors make any representation or warranty as to the completeness of or accuracy of the information in the case studies. So with the disclaimer being done, let's go into the fun part. So let's find out more about the banking crisis and what leads to the bank runs. So for the first bank crisis, we will look into two. For here is 08 and 09 global financial crisis. And as such, we will look into these two banks. One is the famous one, which is the Lehman Brothers, where they announced bankruptcy during this financial crisis, and also Citibank, which was also being severely affected in this financial crisis. So actually, before we explore about Lehman Brothers or Citigroup, let's find out what actually happened during the 08 and 09 global financial crisis. So first thing is that for this crisis, it was started because of a subprime mortgage. So what the subprime mortgage actually means? It means that the banks actually lend money to people who has very poor credit history, such as like maybe people with very low income, or they are having trouble to pay back their loans. And as such, this group of people, they are actually considered high risk. So with high risk, the bank will definitely want to charge a much higher interest for those loans. So this is known as a subprime mortgage. So now in this diagram, we will see that here in the first part, so the bank make a loan to the property buyer. For this is the group of people who might have a poor credit, and they will have to pay interest and also repay the loan for the mortgages that they have. And because of this, as the mortgage, as this mortgage loan is easy to get, so many people will wanted to own a house of their own. And some people might say that, hey, since the loans are very cheap, maybe we should get a much bigger house so that we can live in a much more comfortable place. So as such, there's a lot of mortgage that the bank has, and then the bank will pack all these mortgages into a very complex financial securities or instruments which is known as mortgage-backed securities, which is this MBS. And for this MBS, they will sell it off to investors, and investors will buy into MBS because the bank promote them as very high yield. And also the reason for the high yield is because they are charging this group of people very high interest rates. And in addition, all these mortgage-backed securities, they actually have a collateral, which is their homes, the real estate. So in the event that if the person could not pay back their interest or pay back their loans, then they will take back their house as a collateral. So as such, these are seen as very safe, and investors decided to buy into it. And because as more investors are buying into the MBS, and the bank saw that this is a very great opportunity, then they put out more mortgage loan to more buyers, and this slowly builds up to become a housing bubble where there's a lot of demands that people want to buy their homes, and they took up the loans as such. And when the bubbles grew bigger and bigger, there will be bound to have some people are having trouble to pay back their loans. So when they default on their loans, then the bank is starting to having trouble because they could not receive back the loans from the people who defaulted. And as such, this triggers the start of the global financial crisis. So this is the gist of what actually happened during 2008 and 2009. So now let's look into the banks and how it led to its collapse. So for Lehman Brothers, it's actually an investment bank. That means they take people's money and help them to invest. So it's not like our normal DBS, OCBC, where we will open a checking account or savings account to store our money there. But they will take the money from their clients or the investors and help them to invest. So this is what Lehman Brothers is as a bank. And for this bank, they actually has a concentrated portfolio of very high risk assets. So with high risk, they will seem as high rewards. And in addition to that, they also took on very high debt to finance their operations and make more investments. So, especially into MBS, because earlier on we have seen that since MBS is considered as a safe investment with real estate as their collaterals, and also they have a higher yield and people are having higher demand for it, so they decided to take high debt to invest heavily into the MBS. And when people started to default on their loans, they were deemed to have some investors, they grew concerned about the bank's exposure because as they are invested heavily or they are heavily exposed to the MBS, then they will see that can the bank actually solve this problem? So some investors, when they grew too concerned, then they fear for their money, so they wanted to withdraw their funds. And with many people are withdrawing the funds, the Lehman Brothers are now encounter a liquidity crisis, which means that they may not have the money to pay back to all their investors or all their clients. Like what we see in the earlier video, that the man says that the money is not with the bank because the money might have been loaned out to other people or maybe do some other investment. So they are unable to give back the money to the clients. And this led to a bank run because everyone fears for their money might be gone or might be lost, so they just want their money back. However, for Lehman Brothers, they did not manage to receive any bailout for the governments, and as such, the story goes that they encountered bankrupt during 2008-09 global financial crisis. So this is what led to the collapse of the Lehman Brothers. Now let's look at the next bank, which is Citibank. But for Citibank, it is not really a collapse, but merely a fiasco. So for Citibank, it is an American consumer and commercial investment bank. So as such, they have a very diversified business model. Unlike Lehman Brothers, where it is only an investment bank, Citibank actually caters to consumer banking and also commercial banking or the corporate banking as well. And they also have a large portfolio of assets, means that they have a larger balance sheet compared to the Lehman Brothers. And similar to Lehman Brothers, Citibank actually borrowed heavily to finance its investment, and they are heavily involved or exposed to subprime mortgage market and also the MBS. And when the borrowers actually default on their loans, as we've seen earlier in the slide, their values of the securities actually plummeted. So it causes a very significant loss to Citibank, and they actually struggle to meet all these debt obligations. And Citibank encounter or face the margin calls when they have to pay back for the debt obligations. And you can see in 2008 and 2009, the share price of Citigroup actually dropped from about 500 down to below $50 or almost like $10 or $20, which is quite a drastic drop during the financial crisis. However, for Citibank, they are able to receive bailout for the government. So you might be curious that why does Lehman Brothers does not receive bailout, but Citibank receive bailout? Because Citibank is being seen too big to fail, because as you can see that they are not only involved in investment banking, but they are also involved in consumer and also a lot of corporates, commercials, they are involved in those bankings. So as such, if Citibanks are allowed to collapse like Lehman Brothers, it will have a much more severe consequences onto the financial system, which is why the government decided to bail out Citibank during this crisis. So this is roughly what actually happened for Lehman Brothers and Citibank. So now, let's look at the next one, which is the recent 2023 banking crisis, to see that if there's anything similar to something like this. So for tonight, we will look into Silicon Valley Bank and also Credit Suisse. So for Silicon Valley Bank, as early on the video, it has shows that it is actually a leading commercial bank for startup companies, especially in the tech industries and also the healthcare firms. And during the 2020, during the bull run in the tech industry, where everything is like, everyone is being locked up, so most of the people will say that, oh, tech industry is the next big thing. So as such, all this tech industry, they receive a lot of money and they deposit it into the Silicon Valley Bank. So all the deposits that they receive from their clients in the startup companies, they are actually invested into long-term bonds and treasury bonds. So imagine that when someone has a lot of money, they might not want to keep it in the bank where the interest rates are low. So they might want to invest their money into an investment vehicle, like for example, fixed deposits, or maybe into the stock market, so that the money can grow and beat the inflation. So Silicon Valley Bank also did the same thing, and they decided to invest into these bonds is because it's considered to be safe. However, they are actually invested into a long term, means that maybe for 5 years, 10 years, and they could not touch the bonds. So when the interest rate was being increased by the Fed government, the bonds actually declined in value. So some people might be thinking, what is the relation between the interest rate and the bond price? Later we will see how this actually works out. And as such, SVB actually had a significant amount of unrealized losses. So unrealized losses means that it is kind of paper loss. So even though they might have some losses on their balance sheet, as long as they don't sell off the bonds, it is just a paper loss. But a loss is only recognized only when they sell off the bonds. So, for example, if let's say one person purchased a bond at $2, but then interest rate increases and the bond prices decreases to $150, as long as the person does not sell off the bonds, so it is considered as a paper loss. So on paper, he is having a loss of 50 cents. But as long as he holds it to maturity, maybe the bond price will increase back to $2, so he does not have a loss when it reaches maturity. But if the person has a need for money immediately, then he has to force to sell the bond at a loss, so he will have an actual loss of 50 cents. So this is what unrealized losses is. And as such, because there was announcement that SVB has a large amount of unrealized losses, and also on the social media, there's people saying that you should pull out your money from SVB. So the investors actually lost faith into the bank and they withdrew the money from SVB. So as more people are withdrawing their money from SVB, SVB does not have the money inside the bank. So they are being forced to sell the bonds at a loss of $1.8 billion, which is quite a lot. So as such, the investors grew more concerned about this, and this led to a massive bank run, which is a liquidity crisis. So FDIC has to step in to stop this panic. So FDIC is in US is a Federal Deposit Insurance Corporation, where they ensure that the money invested, the money put inside the bank, deposited in the bank is being insured. If anything happens to the bank, then the depositors can retrieve back their money. So for FDIC, it insures about $250,000. But because Silicon Valley is a commercial bank where all these startup companies, they will store a lot of money into the bank, such as the payrolls or maybe their cash flow into the bank. So it's definitely more than $250,000. Okay, so now let's look at Credit Suisse. So earlier we see that it's because of the high interest rate and the SVB's money is being locked up in bonds and people lost faith into the bank. This is what led to the bank run. But how about Credit Suisse? So for Credit Suisse, it's a much more different scenario, and it is actually being tarnished by a series of self-inflicted scandals. So let's see which are being caused on Credit Suisse. So the first one is back in 2021, it is being hit by a green seal scandal, which means that for this fund, they actually lost money into this green seal. And then next, they also have another 5.5 billion loss from Archegos hedge fund default. Then next up, Credit Suisse is actually found guilty in a cocaine cash laundering. And they announced the biggest loss since 2008. So now people are starting getting jittery. And when SVB collapsed, it caused more concern for the people. So when their largest investors, which is the Saudi National Bank, says that they could no longer put in money into the bank, then people start to worry about it. And people are starting to lose faith into the bank. So Credit Suisse has to turn to the Swiss government for help to boost their liquidity. And Swiss government actually asked UBS to help out with Credit Suisse, and UBS decided to purchase over Credit Suisse, and this led to the collapse of Credit Suisse. So for here is that Credit Suisse actually has a lot of scandal going around, so people are starting to having some losing faith against this bank, and slowly when SVB collapsed, it actually triggers more concern for the people who invested their money with the bank. Okay, so now let's compare between the global financial crisis and 2023 crisis, because you can see that both of them are some kind of financial crisis, but what are the differences or similarity like them? Like for example, like this picture, like both of them are fruit, but one is an apple, but another is orange. So even though they look similar, but there's something slightly different between them. So the first differences that we can see is actually the trigger point. So for the global financial crisis, it was actually the borrower that default on the mortgage payment that triggers the financial crisis. And for the banking crisis, actually the high interest rates that causes certain banks to default, as there was some form of a bank run. And the similarities between them is that there's a certain concentrated risk between the banks. So for Lehman Brothers, is that they have a concentrated portfolio of high-risk assets, and SVB has a concentrated customer base of tech and healthcare startups. And because of all this incident, it leads to a loss of confidence in the bank by the depositors or the investors, and this led to a bank run. So this is what actually happened between the GFC and 2023 crisis. So now, with this being said, some people might be thinking, then what should I do with my money if bank is considered as unsafe, since we see that some of these banks actually collapsed? So there will be trigger some fear like, what should I do with my savings? Is my savings safe if I save it inside the bank? So actually in Singapore, we actually has this scheme known as Singapore Deposit Insurance Corporation Limited, known as SDIC. So what really is SDIC? So SDIC is actually a scheme that actually protects the insured deposits with a bank that is up to maximum of 75,000 in the event that if the bank actually collapsed. So for example, if you have saved money in certain banks in Singapore, like for example, DBS, OCBC or UOB, then if your savings account is less than 75,000, then it is being ensured that you can get back your deposits. So some people might be asking, since I might have multiple accounts in the same bank, how does this actually help me? So here in the FAQ, they actually says that if you have the multiple accounts in the same bank, like for example, savings account or fixed deposit, then they will be aggregated and covered up to 75,000. So now there comes another question. Some people might say that I don't have just one bank, I have multiple banks and multiple accounts in different banks. So how does this able to help me? So for this one, here they mentioned that your deposits will be covered up to 75,000 for each bank. So that means if you have certain amount of money in bank A and certain amount of money in bank B, so in bank A you will be covered for 75,000 and bank B also covered for 75,000. So for more information, you can go to this website to find out more, because there are certain banks that are being listed under the SDIC scheme. So here's the website, which is sdic.org.sg. Okay, so right now, once we have understand a bit about what does the banking crisis happen and how does it lead to the bank run, we will have to deep dive to understand that what actually the bank does to earn money. So the first thing is they actually earn money from interest income. That means they lend money and then they also charge interest. So when people have extra money, they don't know where they want to put their money. Maybe inside under the bed or inside the biscuit tin, which is not safe. So they might consider, I'll save my money into a bank, which is considered as a safe place. So when you save your money into the savings account, the bank will definitely give out some interest. So before the recession actually happens, usually the bank will charge only about a mere 1% interest, for example. And then with the money stored with them, the banks will lend the deposits to businesses or maybe other people that needs money. And with that, they will charge at 10% interest for those loans. So this is known as the cost of borrowing. And they will pay the bank interest for borrowing the money, and this is their interest income. But because as your money is put with the bank, they will need to minus off this 1% interest to become their income. So you will be able to get back your 1% interest, and the bank keeps the 9% interest, and this is known as the net interest income, which is the earnings that the bank makes from lending money. But because of the high interest rates, then the bank will set up a higher interest to attract more people to deposit money. So let's make changes to the scenario. For example, if the bank charges 3% interest for the money that you deposit with them, and let's say that, for example, they did not change their cost of borrowing, we still remain it as 10% interest. So how much of the net interest income will they get back? So you will get back your 3%, so 10 minus 3, so the bank keeps the remaining 7%. So we can see that actually when the interest rate increases, it actually affects their interest income. So you can see that as interest rate increases, the cost of borrowing might be also increased. But earlier on that example, to keep it simple, we keep it the same. But in short, when people wanted to borrow money from the bank, actually the cost of borrowing is actually increasing. As such, the demands for the loans decreases because borrowing becomes much more expensive. They need to pay much more for the interest for the money that they borrow from the bank. And when there's lesser people to borrow money from the bank, the interest income of the bank actually goes downwards. So the bank is actually having some certain losses. So now we know that the first way that how does a bank make a money, then the second way that the bank can make a money is via non-interest income, which is charging certain service fees or maybe commissions. And here are some of the examples of how the banks actually earn the non-interest income. So besides earning interest income and non-interest income, they actually invest certain funds in various financial instruments such as stocks and also bonds. And now let's look at how does high interest rate actually affects the bond price. So people might be thinking that why does high interest rate causes the bond price to fall and led to the collapse of SVB? So the first thing is about opportunity cost. So for opportunity cost, it means that when SVB purchased the bond before the high interest rates, actually the bond price is, let's say, for example, at $1. But then when the high interest rate increases, then the older bond becomes less attractive compared to the newer issued bonds, because the newer issued bonds, they are able to give a much more higher yield. So as such, it causes the bond price to decrease as people are has less demand for the older bonds. And the next one will be inflation. And when it's inflation, it means that it will cost more for people to purchase. So as such, the investors will want to have a much more higher demand of the yield, and it will be there will be a loss for their loss of purchasing power. So as bonds are fixed payments, so when the interest rate increases but the bond still remains the same, then as such, people might be losing interest into the bonds. So this causes the bond's price to go lower as the bond has already lost interest. And the next one will be risk of default. So when the interest rate increases, then it will be some certain bonds will have a higher risk of default. And as such, higher risk, people will want to have a higher yield of demand. So this makes the bonds become unattractive and the bond price decreases. So all in short, is that when the interest rate increases, the bond becomes less attractive and there's a lesser demand. So the bond price goes down. It's because the bond is actually a fixed payment instrument. So at the moment when you purchase the bond will only pay this amount of interest income for you. But if the interest rate keeps on increasing, the initial old bonds that you purchased, the payment will remain the same. So as such, it becomes less attractive and become lower demand for certain investors. So now let's look at the Bank of America. Okay, so early on, we know that Buffett actually is discussing with Biden administration or the US government on how they can help out with the banking crisis. It's because Buffett has a long history to step in to help the banks during crisis. Like for example, for Bank America, they actually got some capital injection from Buffett in 2011. And for Goldman Sachs during 2008, they also received about $5 billion lifeline from Buffett to help them tide over this crisis. And now, let's look at Warren Buffett's latest portfolio. Okay, so this portfolio is dated at 2022 in December, and we can see that his second largest holdings is actually Bank of America, which takes up about 11.2%. And his last purchase for Bank of America is in July 2020, where the average purchase price during that time is about $24.65 per share. And based on the latest Bank of America share price is about 27.98. So will Warren Buffett wants to purchase Bank of America? We will have to see. Okay, so Bank of America is actually one of the largest US financial institutions, where it operates in 50 US states and also some international markets such as the Europe, Asia, and Latin America. And it has actually 8 lines of businesses in 4 major business segments. So now let's have a quick look at what are the business segments that Bank America has. So first thing is in consumer banking, where retail banking is for consumers such as normal people like us, where we wanted to do some savings or maybe receive our money from our employers. And also preferred banking is for entrepreneurs or small business owners. And for global banking, here are mainly for corporates or maybe big businesses. And for business banking, it is for small or mid-sized businesses where their annual revenue is about 5 million to 50 million. And global commercial is for mid-sized commercial, which is about 50 million to 2 billion of revenue. And this one is a bigger company where their annual revenue is about more than $2 billion. And for global wealth and investment management is to help those high net worth individuals to manage their money or help them to invest their money. And for global markets is actually for investing or trading activities such as invest in equities, commodities, or forex. So these are the 4 major segments of Bank of America. So we can see that Bank of America actually have different sources of revenue from all these four major segments. So right now, let's look at how much of each of these segments contribute to the revenue for Bank of America. So in 2022, Bank of America actually generated 95 billion US dollars. And this is the breakdown of their business segment. And we can see that almost 41% comes from consumer banking, then followed by global banking, global wealth and investment management, and finally in global markets. So we can see that most of the revenue are actually coming from our normal day-to-day life, normal people. And their income source, they break it down into two types. One is the net interest income, and the other is the non-interest income. So we can see that the net interest income is taking the lion's share, which is about 55.3%. Okay, so now let's look at certain numbers, because we know what Bank of America is, how they generate their revenue, but are the financial numbers good or not? So we will do a quick screening. This does not mean that here shows that the bank is good and now is the time to buy, because we won't know that what is the actual intrinsic value of this company, of the bank. So the first one we will look at is their profitability metrics, which is their revenue. So revenue is actually how much sales they are able to generate from their business activities. So we will look into a 10-year trend. So we wanted to see the trend to be positive and consistent. And we can see that since 2012, the overall trend for Bank of America is actually going upwards, even though they are having some losses during the early days of the COVID pandemic. But then they managed to recover since then. And next, we will also look into their earnings per share. So earnings per share means that for every share that an investor purchased, how much earnings can the bank generate? And here, we also wanted to see that the trend to be positive and consistent uptrend. So for Bank of America, their latest EPS is actually 3.21, which means that for every $1 that the investor purchased, the bank are able to generate about $3.21 of earnings. And the trend for this one is also in a consistent positive uptrend. So now we know that actually Bank of America is able to generate sales or make increment earnings, but how are they doing actually itself? So there are actually other financial metrics for us to evaluate a bank. So for tonight, we will look at loans to deposit ratio. So what really is loans to deposit ratio? So it means that how much of the deposits that the bank loan out to earn the interest income. So the ideal LDR ratio will be 80 to 90%, which means that for every $1 that the bank receives, it will loans out about 80 cents to 90 cents. So this is the ideal condition. However, for Bank of America, their LDR is actually below the ideal, which is about 50 to 60% or 50 to 70%. So some people might think that the bank is a bit too conservative because they are not loaning out a lot of deposits to earn interest income. But in another way, if another person sees that, oh, the bank is actually very conservative, it's not taking a very high risk to loan out most of the deposits out, but they are keeping some of the money back with them instead of giving out more borrowings. And then the next financial metrics, we will also look at their net interest margin, because as we see that the first way that how does a bank generate money is via interest income. And we see that since the bank does not loan a lot of the deposits out to earn interest income, so how much of the margin profitability are they earning? So here we will look at their net interest margin. So based on this mathematical formula, we can see that if the net interest income increases, then the net interest margin will also increases, which means that the bank is highly profitable. So here, it actually measures the differences between the income that is being generated by loaning out the money and also the interest expense that they have to pay to their depositors. If you have remembered earlier on the slides that we compare between interest income and also net interest income. So we see that for Bank of America, since 2012, it is actually slowly increasing. But then when COVID pandemic strikes, the net interest income actually drops. But then since then, they have managed to slowly recover. So even though there was a sharp drop for Bank of America, they are able to slowly turn back and become increases their net interest margin. So whether will the bank recover from the drop since the pandemic, there is something that we need to see in the near future. Okay, so when I was doing the research, I also noticed that there are certain ratios that the financial analysts will also use. So for tonight, we will also look into them. So the first one is the liquidity ratio. So the liquidity ratio means that how the bank is able to meet their short-term obligations, such as like people want to withdraw money with its current assets. So usually the current assets are in the terms of cash or high-quality liquid securities. For this case will be the US government bonds. So for example, how fast can the bank turn their current assets into cash to meet the depositors' request to withdraw their money? So here, the higher the liquidity ratio means that the easier for the bank to meet all these short-term obligations. So for Bank of America, it's about 120%. And for fund, we will look into Credit Suisse. Based on their fourth quarter last year, they are actually 144%. So means that actually Credit Suisse is able to meet these short-term obligations for cash withdrawals. And for SVB, when I was doing research, certain articles mentioned that since 31st December 2022, SVB is about 150% as well. So this might cause people to wonder that since SVB has a much higher liquidity ratio, but why does it collapse because of the bank run? Earlier on in the video, the lady actually mentioned that we see that banks actually loan out a certain portion of their deposits for the borrowers to earn interest income. But then if everyone wants their money back, the bank might not have enough money to give all the people. So even for healthy banks, they might also encounter this liquidity crisis. And then other than liquidity ratio, there's also another ratio that the financial analysts will also look at, which is the capital adequacy ratio. So this actually measures the bank's financial ratio because capital for a bank is very important as it helps them to run their operations or even absorb losses. Because certain banks, when they invest in certain investment, they might encounter certain losses. So if they have a very strong balance sheet or has a lot of capital, they're able to absorb losses and it will not trigger a default of the company of the bank. And usually for capital adequacy ratio, they will look into the Common Equity Tier 1, which is CET1. And for CET1, it is actually the highest quality of the capital for the banks where they can fully absorb all the losses. But for the next one, Tier 1 is a slightly less stringent, where these are the capital that can absorb losses, but they will need time for them to convert it to absorb all those losses. So some example of CET1 will be the retained earnings of the bank, and Tier 1 capital will be preferred stock. Okay, so here for the big banks, the regulatory requirement for CET1 is more than 9.5% because this is the much more stringent requirement as a capital for them to absorb losses. And for Bank of America, based on their latest annual report, it is about 11.2%. And for tonight for fund, we will also look at Credit Suisse and also SVB. So for Credit Suisse, based on last year's result, it's about 14.1%. And for SVB, it's about 12.05. So now people might be scratching head that since these two banks the ratio looks like they are quite healthy, but why did they have this collapse? So people might be curious that, can we actually rely on this ratio? So here is actually, this ratio is just a quick reference for us to find out how the bank actually works, whether if the bank is healthy or not. But there are actually much more financial metrics that we will look at to decide if the bank is really safe. So here are some of the questions to really ponder is that, are banks really safe based on all these numbers and all these ratios that we look at? And if the bank is not safe, is there another way that we can protect our wealth? And here in this video, being done by CNA Insider, we will look at three financial experts and see what are their opinions on how you can better protect your wealth. And with that, I'll have my colleague to play the video, and I hope you'll enjoy the session.
The banking crisis has added to fears of recession. Amid such jitters, all the experts we spoke to agree on the key strategies for investors.
For all investors, one thing that they have to remember is diversification. So especially in this environment, cash is also king. So I think investors would do well if they remember these broad guidelines, meaning you should have a certain amount of your money in cash equivalents. You could consider maybe, even the T-bills that the Singapore government is issuing. Second thing, to have equities. So within equities, you could actually look at both growth and also quality. And lastly, in case there's a recession, you should actually have also investment-grade bonds, because when you do have a significant economic slowdown, central banks would likely cut interest rates, and that would be positive for bond prices.
Investing is about buying and holding good quality companies and actually buying more of them when their price goes down. And I suppose the only problem today is that prices have not gone down a lot. So it hasn't been that big of a sell-off. Buying and holding, not trading, is the way to invest. And just realize that share prices don't go up in a straight line, but over time they do.
Our aim is for investors to stay very defensive. We are in the late part of the business cycle. We are in autumn. We are preparing for winter. And usually fixed income is the way to go. And by fixed income, there are many parts in fixed income. We are looking into moving towards more into government bonds for the safe haven assets. Investment grade, good corporate bonds are okay. Try not to touch the high yield bond sector, because the high yields will be impacted by credit rating downgrades, particularly when the recession hits. Otherwise, within the equity space, do look into some of the defensive sectors. The usual ones are your consumer staples, your utilities, healthcare, and interestingly, some of the oversold growth stocks in the technology sectors, but good, strong technology sectors, those are still of a very good value. Otherwise, I will be looking into gold as a safe haven asset as well.
Investors can also consider longer-term themes.
A direct play at this moment would be the Chinese equities market, and a secondary play could actually be a China plus one story, which that then includes India and Vietnam. There are also other themes out there that could be more thematic in nature. So for example, ESG. Investors could be looking for companies that benefit from the policy tailwinds of ESG. And even for technology, currently there's this excitement about ChatGPT, about generative AI.
If you're looking at financial investments in financial markets, then not investing in a single company or a single country or a single sector, but really trying to be more diversified across global markets. Also, I think making time your friend is really important. So those institutional investors who have long-term investment minds don't really focus on short-term returns. And the market is quite efficient, but in times of crisis, it can be inefficient, and there's a lot of mispricing in markets. And therefore, having a long-term mindset allows you to pick up value investment opportunities that will give you good returns over the long term, especially in times of crisis.
The recent failures of financial institutions have also sparked concerns among customers about their cash deposits. But analysts say that money kept in banks is generally safe.
There's this insurance scheme over here in Singapore, so up to $75,000 you'll be insured. The banks over here in Singapore, regardless of whether it's a local bank or it's a foreign bank, the regulations actually applies to them. So, so we are confident that the banks in Singapore are basically safe.
Maybe the money market fund is a good alternative for you to invest in. Because money market funds obviously are mark to market every day, has daily liquidity, no lockup. So those are attractive like liquidity management, cash management solutions, and they represent almost 20% of bank deposits in the US. So it's a very popular, common way to manage your liquidity.
Hi, welcome back. I hope you have enjoyed the session being done by CNA Insider. And from there, I believe you have seen some of the experts actually share that how you should protect your wealth. One of them is from Lions Global, and then another one is from UOB, and also another one from a foreigner. So here, let's do a quick recap or summary of what they actually said. So for the first expert that actually says that you have to keep a certain portion in cash reserve. So as he mentioned, for cash reserve, it's unlikely that we'll keep our money inside a Milo tin or maybe under our bed. So usually we will prefer to keep it in the bank. So in order to keep it in the bank, make sure that you keep it inside SDIC insured banks so that your deposits are being insured up to $75,000. Then next, if you have a lot of money, instead of depositing in one bank, maybe you can consider deposit in different banks, because earlier on we've seen from the FAQ that if you only save in one bank, everything will be aggregated up to $75,000. But if let's say you store in Bank A, it's $75,000, and Bank B, another $75,000. So maybe you can consider to diversify your deposits if that's the case. And also another expert actually mentioned to invest in low-risk assets such as in government bonds. For Singapore is Singapore government securities or Singapore saving bonds or even T-bills, which he mentioned explicitly. And also another expert actually mentioned to invest in equities, such as in good quality companies and also defensive sectors. So now some of us might be considering that the first three might be easier to do, but if I wanted to invest in equities, how can I do that? How do I know that which companies are good quality or which sectors, as they mentioned in consumer staples or healthcare, but how do I know these companies are worth my time to invest, as we have seen that between BSC, Credit Suisse, and also SVB, these are considered quite healthy banks based on their liquidity ratios and also capital adequacy ratios. So how do I able to decide on which one should I invest in? And in order to invest, Caden always mentioned that to invest, you need to have a two key preparation. One is to know what to do and what not to do, which is gaining the knowledge. And the second thing to invest is that you need to have the cash to do the investing. So in our upcoming video, we will see how our graduates who has joined our program and how they manage to benefit from learning the value investing methodology that is being taught in VIA. So now, please enjoy the video.
The number one obstacle that will prevent me from investing is my bad past experience. I was scammed before, so I really am traumatized about it.
I'm more concerned about the losses that I may incur without proper knowledge.
So some of my friends and family has actually lost a lot of money in investments, and that was probably like the biggest obstacle that I have to overcome in order to make my first move into putting real money into an investment.
To be honest, I made some errors in the past in stock investment as well. I just put in money without knowing. After attending the VIA course, that was the most important turning point for stocks. Yeah, after that, the portfolio just went up and up.
I decided to source for a reliable training, and I found VIA. I took up the course and I learned that, okay, there is another side of investing, that we can do this very rationally.
I remember I did not fully comprehend the concept then. In the end, I attended VIA because Caden's life experiences and achievements were convincing.
Wow, investing has improved my life, especially the unusual strategy, the cash flow option strategy that Caden taught us. And plus, we know how to scan and screen for good and cheap companies. So I've been earning premium since last year, so it's been 1.5 years. So I have very regular passive income, and it really improved my life because I have a hope of an early retirement and giving more to my family.
So investing has definitely changed and improved my life by giving me back my time freedom. So a lot of people think that investment is about money, making money, but no, it's actually not. It's about what money can do for you, and the number one thing that it has helped me is that it has brought me back my time freedom. So right now I'm semi-retired. I get to spend a lot of time with my family, kids, and friends as well, and of course I can go travel anytime I like because I don't have to worry about my finances.
By investing in right companies or stocks or whatever, I give a better chance to myself, my family, my children, a better starting line. You know, in the future, they have more resources, they can do whatever they want to do. I think what really pulled me to VIA was Caden.
Caden?
I attended his masterclass, I heard him speak, and I've heard other speakers speak for their own masterclasses. And Caden's humility and honesty was obvious. That this guy is not out there to get you to sign up. He's just there to show what he knows and let you learn about investing his way. So I found his honesty really, really enticing.
Well, I've heard other value investing presentations so far, and I found that Caden to be very sincere, knowledgeable, and I believe that he is teaching in a way where it is through his honest opinion and experience. So I think that is very useful coming from somebody who's you are trying to learn from. That's why I decided to go with Caden and VIA.
If you want to be financially free, learn from people who have the means. If you want to be rich, learn from the rich. Only those people can teach you these things. So I came to VIA searching for a mentor, and I think Caden is actually quite a perfect one because he gave us a mindset, and that was the most precious thing, a habit that he gave us for investing.
So in terms of investment results, in terms of ROI, is about 10 to 15% per annum.
1.5 years, I doubled my savings.
I have been investing for 3 years now, and proud to say that one of the stocks that I own is now a two-bagger. And a two-bagger means it has gained 200%, so I'm quite proud of that.
Since I started in October, November period, and by now it's about almost a year already, and I got about 29% of ROI, and I think that's fantastic considering the fixed deposit interest in Singapore. Thank you.
Hi, welcome back everyone. I hope you have enjoyed the video, which is nicely done by our in-house production team, Susie and also Irfan. So they managed to shot this during one of our symposium session where most of our graduates come and tell us how they managed to benefit from our program in VIA. So with that, if you are not sure that whether is this program suitable for you, actually we have a complimentary value investing masterclass that is upcoming, where you will be able to learn 3 ways on how to generate sources of passive income, even though if you don't know anything about investing in the first place. And we will also teach you how you can start to invest with minimal capital. And you'll be able to learn how to create a cash dispensing machine, where Caden will show you that how you can start to generate money and to replace your existing income with our cash flow options strategy. And these are the dates that is our upcoming masterclass on 15 April, which is a Saturday, and 27 April on a Thursday. And when you come for the masterclass, you are not only start to learn about the 3 things that we mentioned earlier, you'll be able to get a free book gift, which is the Value Investing Simplified, that is worth about $33. And also a Singapore Starbucks card with $10 being credited inside the card, where you can buy a cup of coffee and also enjoy the book while reading it. And should you bring 1 or 2 friends, you will also receive a $20 worth of the NTUC voucher and also a movie ticket. So if there's a latest show on cinema and you think that maybe I wanted to watch it, you can also use this movie ticket to watch. But do take note that even though you bring 1, 2, or 3 friends, you will only receive only one portion of the NTUC voucher and also of the movie vouchers. However, your friend will be able to receive the book and also the Starbucks card. So all in all, it is almost worth of $43 and also priceless training by our founder, Caden Chang. So with that, this is coming to an end for our session, and early on I've seen a question being raised up by Wendy that whether if we can use our VIA calculator to find out the intrinsic value of BAC. If you have access to our financial calculator, you may be able to do so, but for this session, it is not suitable for us to share about the intrinsic value, so I'm sorry about that, but you definitely can use our value investing calculator to find out what is the intrinsic value. Intrinsic value means that what is the real value of the company, whether is it now a cheap price to buy or is it too expensive to buy. So from there, you can make a decision that whether now is a good time to buy the company. And should you be curious more about the about VIA Financial Calculator, do join our masterclass session since it does not cost you anything. And you can learn more about it. And I think that there's also other questions. Yeah. Okay. So my colleague has already posted a link for the masterclass, so you can see the link there, and you can click on it and sign up, and also find out more from our landing page to find out what VIA is all about. So all in all, I hope you have enjoyed the session, and should you like the session, do give us a like so that we will know that what do you like, or whether is this the content that you enjoy watching. And all in all, we care to make you better investors in Value and Investing Academy. So thank you everyone, and I hope you have a pleasant evening. Thank you.